Oh,
Good morning.
morning. I haven't put my makeup on yet, so I'm gonna stop my video.
Okay. I went ahead and already recorded, so no more funny laughing because if I didn't, I would forget.
Then I'm gonna mute myself because that's impossible.
Yeah, I get it. Angel, how are you guys?
And
Doing good.
we'll be back.
Doing good. Jake's role playing with somebody right now.
Oh, I
So,
love that. Who's he role playing with?
um, I don't know. Somebody, so on Vulcan, we just got Vulcan and they have like a little group. And
Oh, yeah.
he spoke with a few people and he set up some role playing
Oh, I love
times.
that.
Yeah.
That's
So,
amazing. Sorry,
yeah.
Okay.
he's
All right.
explaining.
Say hey, Jake.
Hey guys.
All right, we've got people popping on. We'll give it just a few minutes. Has anybody got any wins from the last week? Oh,
I have
Anna's
a
like,
win.
oh,
I
please
have
go
a
ahead.
win. I'm driving, so I'm not on camera, but I have successfully onboarded fully with EXP and didn't lose my mind. So yay.
Yay! You did it.
Yeah, everything's up and going. We have the team. We are gonna make the big Facebook post today,
Yep.
and we got everybody over. So pretty much all of our team came over now and a couple of others. So we're good to
Awesome.
go.
That's exciting. Anna said Kurt Shewell runs role play every morning. Find him on Facebook. One of your online partners in Michigan. So Kurt is, if you are in our downline, Kurt is in our upline. So you can always plug into that. So Kurt Shewell is a great resource as well. All right, we've got a few other people popping on. Oh, welcome, Miranda, Kristen. We've got Sarah Christofak.
I usually never have to have my light on, but I'm going to turn my light on because it's so gloomy here.
We are on a delay. I can hear your voice from over there, and then I hear it on the computer like 4 seconds later.
I'll mute in just a minute and you'll be fine.
We have a win that we would like to share.
Oh, please.
Jake.
Well, we started using Vulcan 7, and I was using the batch dialer for the first 3 weeks. And my first day on Vulcan 7, I called the expired listings, and 30 minutes into it, we got our first listing appointment. So that's exciting.
Oh my gosh. Congratulations. Do you guys feel prepared? Do you guys want to if you need any help with any of us, we're all happy to sit down and help with it, with your listing presentation and all that good stuff. So just lean on us for whatever you need.
Okay. Yeah, we need help.
Yeah. Just give us a call, and Lauren and Courtney and myself, all of us are here. So just come into the office, give us a call and plug in and we got you.
Okay. Thank you. Appreciate
You
it.
did the hardest part.
Yeah, that's
Yeah.
what I heard. The cold calling and trying to get them in the door or get yourself in the door is always the hardest. So
yeah, you did the hardest part. Like, pat yourself on the back. You're good. It's all uphill downhill, but in a good way from here. Like, yeah, you're good. Awesome. Sonia, hey.
Hey, how's
Look
it going,
at
everybody?
you. Good.
Good morning, Sonia.
Good morning, Melanie.
Oh, we've got so many great people popping
When I
on.
went to go send you that link, I was stalking your Instagram for pictures of that baby because he is just so cute.
Oh my gosh, I agree. I completely agree. Thank you.
Hey, Allison, I was gonna say, Jake and Angel, if you guys shoot me a text with your email, I'll send you my prep to sell guide and my preparing for a home inspection stuff that you guys can edit and tailor to you guys for your listing paperwork if you want.
Love that.
Yes, please. Thank you so much. We appreciate it.
Do you have Stephanie's email?
I have her Facebook. So
well, if not, you know what? Trick of the trade, because people are always looking for contact. you always forget, just go into MLS. You can find her on MLS and you can find her phone number. Oh, I just put my thing on. You can find her phone number. You can find all of her information. So the easiest way to find realtors is just to use the MLS. So, so pop on MLS and shoot her a message, and that's great. And for anybody that is in town and in person, in the Low Country, Anna will be here next Friday. So put it on your calendars. We are going to be doing, I'll send out the exact times, but we're going to be doing like 9:30 to 10:30, opening your playbooks, looking at what your gross commission income is, looking at your business setting and your goal setting, where we are in Q1 so far and where we're going. And then anybody that hasn't done Working Genius, it's really wonderful to do it in person. She's going to run Working Genius. And then she's going to be doing one-on-ones or two-on-ones or group-on-ones anytime between like 12:30 and like 3:30. So we'll have a calendar that goes out so that you can kind of book a one-on-one with Anna. And that's going to be really impactful and powerful for people to be able to sit down with Anna and kind of pick her brain. So make sure next Friday, the 15th, that you guys are mark your calendars. Okay, I think we've got some people popping on. I'm admitting a few people, so I want to give you guys an introduction. We have got Melanie Ott on. When Anna and Ashley and myself started this whole Agents Empowered, and we started the Wednesday Masterminds, the premise of this was to be a agent mastermind, right? To have agents from all over the country come on, talk about their strategies and all that good stuff. And so what we thought was really important was to actually ask a lender to come on and to talk to us about some of the things that's a little deeper than the average, like rates are going up, rates are going down. And so we're super excited to have Melanie on. Sorry, she's in my office right now, so that's why there's reverb. So go ahead, Melanie.
Sorry. We had possums this morning that needed to be delivered to Allison. So that's why I ended up here so early. Okay, so before I get started, I just want to say thank you for having me. As she said, my name is Melanie Ott. I'm with Gateway Mortgage. I'm based here in Beaufort, but I can lend in 42 states. So I am your girl no matter where you are. I think that it's really important for agents to be able to, agents empowered, to be empowered to help their clients in a way that maybe they hadn't been able to before. And so my goal today is just to help you to understand a little bit more about the Fed fund rate, because it's a funky thing and a lot of people think that it is something that it isn't. So my first question to you is, does anybody have any idea what the Fed fund rate is? Nobody? How many of you think that it sets mortgage rates? Anybody?
I guess I think that it does.
So it doesn't, but it does. It isn't a mortgage rate, but it does influence them. So we'll just dive right in and we're going to get started. Might do this backwards. I'm trying. First time having to present the little Canva thing. Y'all, I love Canva. Okay, nope, I have to share my screen first. I'm not doing this right.
I gave you permission, so you should be good.
All right.
Yep,
I've forwarded it. All right. Are we there? Can everybody see?
You're good.
All right. So demystifying the Fed fund rate. I'm going to go through the who, what, when, where, and why. First, sorry, I'm learning the clicks, is the what. So it is not an interest rate. It's actually the overnight lending rate for banks. So banks have to borrow money to and from each other. So here's the thing. It works because banks have to have a reserve every night. So I'm going to use little numbers. Banks have a whole lot more money than this, but let's say a bank needs to have $1 million reserve because of their size. And let's say that at the end of the day, they only have 500,000. So that's 500,000 that they need to be able to have for their reserves legally. So they go and borrow it from another bank who has an excess of reserves. And that bank lends it to the bank who doesn't have enough for a rate, for essentially an interest rate, but it isn't the mortgage rate. And so that just gives them an opportunity to continue to have the reserves that they need to ensure solvency in the bank, to ensure that they are not going to be, that's what they use to lend money with, for personal mortgages, for credit cards, for for loans, anything like that, anything that a bank uses to lend out money, they're getting it from deposits. That is why banks want your cash. All right, so the who about it is, I know you've heard the Fed, okay? And so the Fed is actually the Federal Open Markets Committee. They're also known as FOMC, which is just their acronym, and the Fed, and they consist of 12 members. Those members are from all over the United States, but the president of the Federal Reserve is from New York. And then there's like a board of governors that have a little more power than the others because they can vote. All right, so they hold 8 meetings every year. They've already had one in January. They're getting ready to come up on another, and then they'll meet every other month-ish. And so at these meetings, they look at different things like the personal consumption expenditures report, like the jobs report, and lots of different reports that come out every single week. So when you're seeing mortgage rates go up and down and up and down and change just a little bit every single day, it's because different economic reports are coming out, and the stock markets are and the bond markets are reflecting those changes. And sometimes even the smallest change can make them think something much bigger is coming, and that's when you'll see a bigger dip or a bigger rise in rates. Questions so far? All right, so the meetings and the predictions. So as I said, they are getting ready to meet, and they will make an announcement on March 20th. Coming into 2024, and even after the January meeting, there was a lot of speculation that the first cut would happen in March. I thought the first cut would happen in March for a long time too, because every single expert was saying that. However, they are not anticipating that at all now. They think the first cut may be in May. It'll probably be very small. But whenever the Fed fund rate gets raised or lowered, mortgage rates usually follow that. And so we think that if the Fed cuts the rate in May, which is expected, rates will probably drop a little bit. And then the thought is that after that, they will probably be making a cut every other month or so. That doesn't, again, experts, nobody has a crystal ball, but they think that it will probably be every month. So then we likely won't see one in June. We will see one in July, but not in September. And then, yes, in November. And then December is up in the air because they're going to want to see if the cuts that they've made in 2024 have evened out the economy the way that they hope. All right. So I mentioned that they have all the different presidents. So there's one president from each of these areas, kind of the big economic areas in the country. And that is where each of the members are seated, if you will. All right, so the whole purpose of the Federal Reserve and the FOMC is to do 2 jobs. The first one is to maintain stable prices throughout the economy and keep inflation under control. And the second job is to support maximum employment, because people without jobs are not spending money. That's, well, generally speaking. And if they are spending money, then they are probably borrowing that money in the form of credit cards, which is in the financial world, it's called buy now, pay later. All right, so the first thing that they have to do is to make sure that the economy stays stable. So whenever they raise the fund rate, a lot of times what they're trying to do is to slow inflation. It reduces the supply of credit and it makes loans more expensive. That's when you're seeing the interest rates on everything, even credit cards, go up, because they want to make it more expensive for you to borrow that money and they want you to use your cash. That'll help to not have too much money floating around in the economy. While lowering it has the opposite effect. So if they make it less expensive to borrow money, people are going to be out there buying cars, buying houses, buying the 75-inch TV for their living room that they really can't afford, so they put it on their credit card. So all of those things are going to make people spend their money, and that's when they're boosting the economy. Questions so far? All right. Maximum employment. So maximum employment. Yep, absolutely.
So, I mean, for me, like, all last year we kept hearing that like inflation is out of control. So essentially what the government's doing is they're trying to put pressure on those that don't have cash necessarily. So it's not really the people that are out there that have the money, that have the cash to go and buy these things. It's the people that are going and opening like credit cards and lending or borrowing against themselves to be able to afford these items.
They're trying to make the cost of borrowing money so expensive, or expensive enough that people don't want to do that. They want to slow that a little bit and say, I don't want you to borrow this money. I want you to hold on to the cash that you have and spend that. And they want to make sure that, I mean, a dollar is only worth as much as, you know, it's worth, and having the cost of that dollar be higher. Slow car the other day, and I asked the guy, you know, how are car rates? Because, you know, and he said people are seeing like a 10% interest on a car. And I don't know about you, but I'm not paying 10% interest on a car. I'm not. And like,
no, my car interest rate was 0%.
That's the kind of thing that they want to happen.
Okay.
Exactly. They want you to see that interest rate and think, I'm not paying that. I'm not paying that at all. So I'm not going to spend that money. They're trying to slow the inflation and the purchasing of that money.
Got it.
Good question. Okay, so maximum employment. So obviously when you hear the word maximum, you think as high as it can possibly go. And as high as something possibly goes is 100%, right? But there's no way that every single eligible person to get a job in the United States is ever going to have a job at the same time. And 100% employment is just not ever going to happen. So maximum employment to them means that they want to keep it at a level that's a normal economic level. Like there are going to be people who don't have jobs, or people who, you know, are doing things like welfare or government support, or even people like, for example, somebody who is on disability. They might not be able to be employed, and that's to be expected. But the goal here is to keep it level. Not a boom, not a recession, just level. So tell people to go get jobs. All right. So in essence, the federal fund rate, this thing's in my way. The federal fund rate is one of the key tools for guiding policy. And the Open Markets Committee, they are the ones who are setting these things. And there are people who are, you know, much more frugal than other people on the committee. There are people who are much more, hey, let's make this happen, than other people. And they have to balance each other out so that they can have a more level economy. So it impacts everything from the yields in your savings accounts, your credit cards, your cars, anything where there is an interest rate in it is affected by the federal fund rate, but it is different. Like right now, the federal fund rate is in the 5s, and you know, you're still seeing interest rates that are low 7s right now. The average interest rate for a 20-year mortgage is like 7.03, I think, today. So you got to keep it level. All right, speaking of levels, there have been some highs and some lows. So in the 80s, the federal fund rate soared to 20%. That's when you were seeing things like the 18% interest rates. That's when people were still paying $40,000 for a house, but they couldn't afford a payment on $40,000 because the interest rates were 18 to 20%. And then there have been twice when they've lowered it all the way to 0. And that's, again, to try to boost the economy. They did it in 2008 when the housing market crash happened, and they did it again in 2020 when COVID happened, because people were not spending money. I mean, a lot of people didn't know when they'd make another dollar, so they didn't want to spend the dollars that they had. So in essence, it is designed only to promote the effective operation of the economy. It is not meant to actually set a rate, an interest rate. All of the bond markets and the Fed fund rate and everything, they all go into a big bucket, and that is how they determine what an interest rate will be. And every single bank gets to determine their own interest rate. So they may be different from person to person. That's why you may see lenders who say, okay, well, I can get you a 7% today and a 6.7 to 0.5 tomorrow, whereas another lender is exactly the opposite for whatever reason, and they don't necessarily match. Or that's why the same interest rate might cost a different amount of points at different lenders. Any questions about that? I feel like I did that really fast.
I have a few questions, just understanding, like, I guess this makes a little bit more sense why when you go into a loan and then you have to do like a rate lock, because the lender is basically saying, we don't know what's going to happen in the next 30 days because everything is so subjective to like what happens with the Fed fund rate and all of these things. And so they only allow you to lock for so long. And it's basically a like an insurance policy, essentially. Is that right?
Yes. So the lock it protects you from any interest rate movement, and there are different costs. There's different amounts. So you get the best pricing on like a 30-day lock. There are some lenders who will give you a little bit better lock if you do like a 14 or 21-day lock. But obviously, that's not a lot of time to close a loan. So you're usually going to be looking at 30, 45, 60-day locks. And that's going to protect you. So it does protect you from rising interest rates, but a rate lock may not be the right thing to do right at the beginning of your loan, because it may be possible that interest rates will go down. So it's important to talk that loan strategy with your mortgage loan officer, and to pay close attention. Like, for example, I personally try very hard to make sure that all my loans are locked before the Fed has a speaking engagement or before a major economic report like the PCE comes out, because almost always we see some kind of wonkiness following those things. Now, that might mean that it goes down a little, but I don't want to risk my clients' money unless they have a very high risk tolerance on a maybe. So I think it's important to pay very close attention to the market, to talk that rate strategy with both your clients and, the realtors can be a part of that conversation sometimes. But we want to make sure that you're being smart with your lock, because it protects you from going down as well. You can't, a lot of lenders do not allow you to float down. Yeah. Does that answer your question?
Yeah, it does. Does anybody else have any questions? I think
come on, I didn't do that great explaining it.
No, I think you did a great job. I think for me, like the biggest thing and the reason like why we wanted you to come on is because a lot of what is driven in our industry, I believe, is from social media. And so you'll see like rates are going down. And as soon as the rates go down, then like everybody's going to be back into multiple offer situations. And I think that we hear like the Fed's meeting, or the Fed's supposed to meet again, like March, whatever. And that, can you go back to the slide where you say like when they're meeting and everything? Because I think that that's what we've gotten really used to. And like, again, we hear enough to just be dangerous, but then all of a sudden it's like, okay, well, the Fed's supposed to meet March 19th or 20th again. Right. And so if we're talking to buyers and they say, well, what do you think the best move is? Well, if you're waiting on the interest rates to go down, then like you'd assume that it's going to happen after the Fed meets, because it's going to be something's going to happen at these meetings that it's either going to make it say stay stable, go up, or go down, correct?
Yes. So they meet for 2 days. So they do most of their meeting on the 19th, and then on the 20th, they'll do votes and they'll make the decisions. And then the chairman, Jerome Powell, will probably have a press conference at 2:00. Usually it's at 2:00 on the second day of the meeting. And he will announce what it is that's going to happen. And he will also make some different remarks on why they made the decision that they made. And sometimes those remarks also, like, let's just say they don't change the rate at all, those remarks can also make the economy go a little wonky and make people think, okay, well, he said this, so that probably means that something is going to happen and that's going to affect rates. So we want to make sure that we are doing what we're supposed to do, like in the bond markets, ahead of time. And they want to make sure that they're investments are protected. That's why they maybe don't buy as many mortgage bonds, or maybe why they're selling their mortgage bonds that they do have. Mortgage bonds and the mortgage bond sales are really the biggest thing that's trackable daily that would affect mortgage rates. Which are just like the stock market. You guys go and you invest in the stocks and things like that. But it's mortgage bonds that do that. Go for it.
What about, they just said that we're at the highest credit card debt I think we've ever had. So, I mean, does that have like a major effect on just they're going to keep it high? Like I know we keep saying they're going to cut it, but we've it's the biggest we've ever seen. I mean, the spike was insane.
It was, and a lot of that has to do with people who are, I mean, like I said, they call it buy now, pay later. And then there are other people like that, like for example, me. I have a credit card and I don't even carry a debit card. That's the only card that I use, is just that. And then I pay it off every single month. And I use it because I get an insane amount of points. It's free money. Why wouldn't I get free money? But I would be included in those numbers. So I don't think that those numbers are always accurate, in that sometimes they're not people who are buying now to pay later. I mean, I guess technically I am, but I'm paying it all off before the due date. And so they do get skewed a little bit. Yes, they want to, curb that, because there are going to be people who cannot pay. Did you see on the news yesterday that they just capped the late fee for credit cards? So there were so many people who have bought now and paid later that I think it was $32. The maximum late fee that you could pay on a credit card if you were late was $32 per month. And of course that adds up, and then you're paying interest on that now, and that just spirals people out of control. Now they have made it where it is $8. You cannot charge a late fee on a credit card that's more than $8. So they're noticing that there are these issues that they need to fix, and trying to figure out how to fix it and how to get people to A, stop spending just to pay later, and B, to actually pay what they owe and not be, just drowning in debt. That's how they're trying to keep the economy level.
I think the stress factor that comes in for me as a realtor, and understanding the market and understanding just like basic economy of it, right, is that as the pressure builds from the Fed and from, the government, and pushing these interest rates higher and higher, the goal and the hope was that the pressure would build enough that prices would start to come down, because then you'd have this intersection between affordability, right? So the Fed can keep interest rates high enough that the pressure builds, houses don't sell, people aren't willing to pay that interest rate, prices start to go down, and you find that affordability crossroads. That's not happening. And I think that the Fed, at least within the last 2 years, from what I've been following, expected it to happen. And there's different markets all over, but we've got people from the Raleigh market, we've got people from the Low Country, and our prices, you saw days on market go up. They went from 2 days to 20 days to 60 days. But the prices really aren't coming down. And so the affordability isn't changing, but we're still seeing a pretty robust market. So the fear factor of it is like, what does happen? Like, at what point does this change? And so for me, I can't see the interest rates going down if the plan of the Fed is to keep pushing for affordability and for people to stop borrowing, because people aren't stopping. They're not stopping.
Right. Well, the whole hope of every single thing is to make it where people are able to afford things. And I think sometimes there are people who see these higher interest rates and they think, well, I'm in no position, I cannot buy a house right now, or I want to pay all cash for a house, or whatever the case may be. But here's the thing, this is something that you should tell your clients, especially those who are saying, I'm just going to wait for rates to drop. You cannot change the price that you pay for a house. So if you are buying a house now, and yes, rates are a little higher, if you can afford to buy it now, and stick it out, then in the next 12 to 24 months, chances are assuming nothing changes for you financially, you will be able to refinance into a lower rate and you will save thousands of dollars likely a year. Whereas if you buy later for a higher price point when house prices have gone up and you have a lower interest rate, you're probably going to end up paying about the same as what you're paying now. So you're not saving any money, you're just paying more for your house, which in turn makes you pay more interest. And then you've got people who are like, well, sorry.
I was going to say, just to challenge that, what if March 19th and April 30th and June 11th and July 30th, like what if these meetings from the Fed, they're meeting and they're realizing nothing's changing and the prices and the inventory is still hitting the market and people are still buying and the interest rates keep going up, because we are at a national low over a 30-year period. And so what if those interest rates just keep going? And eventually, like, is the plan, it's not to tank the real estate market, but it's to adjust it enough that the prices make more sense for the average buyer. I mean, what if that actually is what happens?
Well, that's why I say that you shouldn't be paying this interest rate if you can't afford to pay this interest rate. So even if they stay where they are or they go up, you're still protected because you've got a lower interest rate. Now you didn't wait. And now the interest rates are higher, right? So now you still have a lower interest rate than what you would have if you waited. And you're still in a financial place where you can afford it. I don't encourage my clients to max out and bite off more than they can chew. I want to make sure that they are comfortable where they are. Now, would they be more comfortable if they were paying $200 less a month? Of course. Who wouldn't want to save $200 a month? But that doesn't mean that they shouldn't buy. They've got to make sure that they can afford to buy at a higher interest rate. And then they're protected even more because rates have gone up and house prices have probably gone up too. House prices are expected to go up like 6% this year. That's what the experts are saying.
Right.
So, I mean, I do think we'll see closer to the end of the year, I think you're going to be seeing some more, some multiple offer situations. I know that some of you are already starting to see multiple offer situations, and you're going to see higher home prices. I do think you'll see lower. I know some experts are saying that we'll get down to like the mid fives. I would be really surprised. That's just my 2 cents. I'd be surprised if we saw mid fives. I think that we're probably going to see somewhere around the 6%, 6.25. That's just my guess based on just different experts that I follow. Not that I'm out there reading all of the charts every day and making these predictions based on how many mortgage bond sales we had. I'm not that in see 6 to 6.25. I don't think we'll see 5.5. But you do have, I wanted to say about cash buyers, there's something to say with your cash buyers is that interest rates are high, but you know what else is interest rates? Interest rates on things like money market, high yield savings accounts. I mean, Gateway, for example, is a bank. We're the mortgage arm of that, but Gateway is a bank. They have a 7-month CD for like 5.75, and that's really, really high. So the point I'm trying to make is if you are going to take $500,000 and pay cash and interest rates are, let's say 7%, you're going to pay cash. Well, you could be taking that same 500,000 minus your down payment, putting that into a high yield savings account and making 5.75, where in essence, the $500,000 that you borrowed on your house, now you're only paying an effective interest rate of like 1.25, where you're making money on that. And you know what I'm saying? Like your money is gaining interest and you're paying a much lower effective interest rate because of that. So it really just kind of depends on your risk, your tolerance risk, your risk tolerance. Is that backwards? So
that's awesome. Does anybody have anything?
No. So one thing I would love if all of you, I'm going to put this back on here. I offer information like this on my Instagram all the time. And this is my Instagram right here, Melanie Talks Mortgage. You can scan that QR code and follow me. I would love it if you would, because I want all of you to get as much information as you possibly can. And I want to make sure that you are able to help your clients however, and you're welcome to call me anytime and ask whatever questions. Even if it's not, I have a client related.
This was awesome. Very, very helpful. Melanie is always available and super knowledgeable. And I always feel kind of silly asking some of the questions that I ask because I just don't understand this at a high level. Tracy says, that's why I try to explain my VA buyers wanting to put down a huge down payment when they're going to be in the house for 3 years. Keep the money in your bank and earn interest on it.
So I do a lot of VA. Obviously, Beaufort is a VA area, and I would say that VA is probably 70 to 80% of my business. And so what I would say to those, just like you're saying, I mean, the only reason that I would recommend putting money down on a VA mortgage is if you're going to put enough money to lower your funding fee. And that, honestly, it's like, okay, let's say your funding fee is $7,000 and you lower it enough to make your funding fee be $4,000. I'm totally making numbers up. Then you've only saved $300 or $3,000 in that scenario, except for you've had to put probably $20,000 down to save that $3,000. I don't know about you, but I'd rather be cash positive. I'd rather have that money making interest or furnishing my new house or helping to pay for the move or, planning for my future rather than getting that money tied up in the mortgage. And making it where I can only use it if I go and do a cash out refinance, which also costs me money to do. So I agree. I don't advocate for people to put money down on a VA mortgage unless it is absolutely necessary. Good point. Thank you, Tracy.
Very good. Okay, well, Melanie is available. We've recorded this, so we will put this back onto YouTube. Follow us, Agents Empowered, and we will kick off another week series next week, and we look forward to seeing everybody.
Thank you.
Have a good day.